In this video, I want to review one of the best analyses I have found for LandBridge. I'm a shareholder of LandBridge. I think this is one of the most promising investment opportunity in the coming years. So just so you know, I'm biased, I'm a shareholder, and somebody has made a wonderful video here about LandBridge. Permian treasure, royalties, land, and data centers. The story of LandBridge from Stephen McNamara. So sorry for the pronunciation. Please check his website. He has covered some very interesting stocks, and in this video I will just review to this video. It's a 1 hour long video. Take a cup of tea, take a cup of coffee, wine, whatever you want. I have my big glass of water, and we'll just react to this video, and I will add some color to some specific areas, and you will see that he covers everything. The track record of the company, what is LandBridge, how does LandBridge make money, and at the end, what is the valuation? What is the good price you have to buy LandBridge at? What is a good price? So that's it, and yeah, that will be a react video. Take your time, be comfortable, and we can start. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And now I'm investing in LandBridge because I think it can generate 25% per year in the coming years, or even more. So we will see. Okay, let's start.
Brief, where today I'll present Permian treasure, royalties, land, and data centers. It's a due diligence deep dive into a company called LandBridge. It's one of the newest players in land management and royalties in the Permian Basin. It's fairly similar to another company that a lot of you will be familiar with called Texas Pacific Land Corp, but it has a major difference. LandBridge, unlike Texas Pacific, is poised to be a huge beneficiary for the AI build-out. That's right. Artificial intelligence is triggering a massive construction boom in data centers, and LandBridge is sitting on land that is well placed to capture some of that growth. So far, there's actually some coverage of LandBridge, but not as much as you might think, given that it's a fairly recent company.
Yep, it's a recent company. They went public. LandBridge went public in July 2024. The company was created in 2021 as a spin-off from WaterBridge, and you see some Seeking Alpha articles. Somebody, I think from Germany, called Leo, writes beautiful articles about LandBridge, and somebody on Seeking, I mean, you can read, this is on the internet, on Seeking Alpha, just find somebody called Leo and read what he has to say. This is amazing research here, and you have a couple of interviews, videos on YouTube from Horizon Kinetics. This is a fund, and they are big investors in TPL, Texas Pacific Land, and also LandBridge. So you have, just type LandBridge, Horizon Kinetics on YouTube, and you will find additional data. But I agree with him, not a lot of interviews, not a lot of articles, because this is a fairly recent company.
And the coverage that does exist doesn't necessarily go into the company's history, it doesn't really cover the management team, and these two things are actually kind of core ingredients in the growth story and the credibility behind the growth story, which we're going to see later. But before we get into all of that, first a short disclaimer.
Okay, let me skip. Let me skip the disclaimer.
Research, but keep in mind that what you're hearing in this presentation is my personal opinion, and it's always good to consult with a financial advisor. And with that, let's dive into it. So LandBridge is a land management and royalties company based in the Permian Basin. What exactly does that mean? It means that in order for companies to develop oil and gas resources in the Permian Basin on their land, they need to pay for access to the land. They need to pay royalty fees based on a share of the oil production that is produced on that land. And the land management company does not incur any of the risks or the costs associated with the drilling activities. It simply collects the royalty payments. The company, LandBridge, is new in the sense that their IPO was only in June of this year, in 2024, so it's about 7 months ago. They went public at around $17 a share. They now trade at around $60 to $65 a share. At the time of writing, it's around $62 a share.
Okay, maybe he will talk about this later, but you may ask, yeah, I mean, they IPO'd at $20 per share. Now the stock is at $60 per share. As I'm recording, it's in this range also. The stock has not shot up to the stars yet. Why is the stock price initially so low? If they knew the thesis, if they knew the data center thesis, And if you watch some videos on the internet from Horizon Kinetics, the big fund, they told publicly that nobody really understood what LandBridge was doing. Nobody really understood the story, the investment case with LandBridge. But luckily, Horizon Kinetics has been a shareholder of Texas Pacific Land, a similar company, since 1995, normally. So they know the story really well. You own lands, you get a royalty payment, you have 90% margin, you don't deal with oil and gas, but you deal with water, and they were very few investments in the IPO. So they planned to raise more money, but because of a lack of information, the institutional funds were not interested, did not understand the story. The IPO price was lower than expected. Maybe he mentions this later. So just so you know, this is not cheating. There is no fake number here. It's just a lack of understanding. Officially, this is the case.
It did return over 300% in 6 months, which is not bad for those who got in when the business launched. And so the real question is just why has the business proven to be so lucrative? And what is the growth story behind it? Are these returns going to continue? And these are topics that we're going to cover. But to just give a really short introduction in their own words, land is absolutely critical to energy development and production. They own and have about 273,000 surface acres in a place called the Delaware Basin, which is a part of the Greater Permian Basin. This is the most active region for oil and gas exploration and development in the United States. So it's a really huge deal. And basically land access is important for the entire industrial economy that goes around oil and gas production, as we'll see. And their strategy is to actively manage that land and the resources to encourage oil and gas development, but also other industrial uses on the land in order to generate long-term revenues and free cash flows.
Yeah, a few years ago, even 2 years ago, I think Texas Pacific Land was the only public company that operated with some lands in Texas. You didn't have a clear competitor in this. You have other realty companies, I'm aware of this. You have some Prairie Sky, you have some Viper Energy, Venom, you have other companies, but most royalty companies have a steady production and they give all the profits to dividends. So you have dividend yields of 11%, 12%. So maybe because dividends are taxed twice, I don't want to invest in this kind of investments. What is good with the Texas Pacific Land is that the growth is accelerating and they don't give much dividends. I mean, most of their history, the capital allocation policy was doing buybacks and buybacks. So yeah, the land management businesses are great to own because it's very efficient, 90% margins, and you need the land because the world is advancing. The world is developing into being more efficient. The land is a perfect inflation hedge. So land companies are very valuable in an inflationary era, which is now the case.
It's a similar business to Texas Pacific Land Corp. Now, if you're familiar with the royalties business, particularly in the Permian Basin, you'll be very familiar with Texas Pacific. This is a very old business. It's over 100 years old. It's got an absolutely fascinating history. I did a recent sort of
Fun fact, Texas Pacific Land was created in 1888, a long time ago, and the world has changed since.
Our report on this, the long-form deep dive. Please, go to my website and see the report if you're interested. It'll give you a good understanding of the business. It's also a really good primer going into this presentation on LandBridge, because especially as we get to the valuation section, there's going to be a lot of similarities in terms of how we.
No, that's fine. That's fine.
And also just how to factor in the growth story for LandBridge, because there are key differences between the two. Just to give an idea, for Texas Pacific's sort of remarkable returns in recent years, the last 12 months saw a 185% increase. The past 5 years, 435%, and its 10-year performance is 3,750% returns. So
that's amazing. I have been a shareholder of TPL between 2020 and late 2024. It was a 8x in 4 years, and I sold because of too high a valuation. Since then, it has dropped, so good timing for the moment, we will see. But this is just a spectacular business model. I wish the stock is dropping like a rock, so I can buy more TPL. I can buy it again. It's a phenomenal investment. Because earnings per share, net income, revenue, everything is going in the right direction with 90% margins. Amazing business.
This is something that's Magnificent Seven, and yet all they do is manage land and collect royalties in the most low-risk, predictable cash flows that you'll find anywhere in the S&P. And LandBridge has a similar profile. So what we're going to do in this presentation, we're going to cover four main elements. We're going to explore LandBridge's history, the leadership team, and the business model. Then we're going to cover LandBridge's key financial metrics. And then we're going to value the company. We're going to do a valuation with different growth scenarios, and then we're going to summarize the investment case. Before we get into that, I'll just do a short introduction on your speaker. My name is Stephen McNamara. I'm the author. Sorry,
Stephen. I might skip your presentation in case you want to go to his website. That's this one. Here is a free shout out. Stephen McNamara. Again, sorry for the accent. Check his website. Great articles. Let me just skip to what is important to LandBridge shareholders. But that's amazing. He has a great performance. I mean, 20% returns for 10 years without investing in the big tech, the Magnificent Seven, is just wonderful. So I will read all your articles, Stephen, just so you know.
As well as leading the full end-to-end legal. Going into the very first
okay.
We're going to explore the LandBridge's history, leadership team, and the business model. The history and the leadership team often gets really left out of the analyst coverage that I've seen so far. They tend to jump straight to fancy spreadsheets.
That's true. By the way, Wall Street is not sharing a lot of information on LandBridge. If you look at their price targets, first, not a lot of analysts cover LandBridge. It was a small company, like $2 billion value market cap in the past, so nobody is interested in covering LandBridge. They had a price target of $40. Now Morgan Stanley, I mean, they are increasing to $80. In terms of price targets, they follow what the stock price is moving. They don't share a lot of metrics when it comes to volume, management teams, link with WaterBridge. Seems like you have a lack of information, and maybe Wall Street is not interested in buying this stock. I wish it changes, so you have more information. That's that's easier for us. But for the moment, you don't have a lot of exposure to LandBridge. This is just a tiny company, small company, a recent company.
But this is really what kind of underpins the growth story, and I think it's quite important. So going back, like taking a long view, oil and gas has been drilled in the Permian Basin since the 1920s. The Permian Basin is an oil and gas field up in sort of the west part of Texas. It kind of touches the New Mexico, Texas, and Mexican borders. The first oil gusher was discovered in 1901. It set off a massive oil rush. You can kind of see some old photos in the top left. During the oil rush, oil exploration expanded all over Texas, right? And that led to discoveries in the Permian Basin. And these were known as the gusher years of the Texas oil boom. It ended when the Great Depression started at the end of the 1920s. And then from there on, it sort of went into a steady state. The markets changed over the decades. There was World War II, there was the Arab oil embargo in the 1970s. Importantly, though, the method of drilling remained the same. It was essentially vertical drilling, and that was the available technology up until the early 2000s. So it didn't really change much. Horizontal drilling really gained adoption in the 2000s and becomes much more widespread after 2010 in the Permian Basin. And that's a really important development because that's what unlocks the vast potential of that oil and gas field.
Yep, I made a video a couple of days ago about the latest quarterly letter of Horizon Kinetics, and they talk about this exactly. The fact that before, oil drilling was quite simple, and with new technologies, it has become more complex. You can drill more oil, you can get more efficient, and Texas Pacific Land benefited a lot from these new revenue streams. Maybe there is a case that the same phenomenon of efficiency, more revenue, will be the same with AI and data center and water infrastructure for LandBridge. Oh, I went back to, where am I? Here. Okay.
Horizontal drilling really gained adoption in the 2000s and becomes much more widespread after 2010 in the Permian Basin. And that's a really important development because that's what unlocks the vast potential of that oil and gas field. LandBridge's holdings are in the southern Delaware Basin, which is part of the Permian Basin. So the southern Delaware Basin has some pretty unique attributes. So first, there's some significant operational challenges. There's a lot of different layers that are quite complicated, and that requires horizontal drilling that is very targeted and hydraulic fracking, otherwise known as fracking, in order to get at those resources. It's got very high productivity in the sense that the oil is in these kind of rock layers, and those are stacked on top of each other's. This is the pay zone, so stacked pay zones. You don't get to access all of them with vertical drilling. So when you have the right adoption of sophisticated horizontal drilling and fracking, you get to a lot more productivity out of those wells.
Exactly.
In the region where LandBridge owns land, they have more wells per area and some more complex well designs. And very importantly, though, the adoption of this horizontal drilling and fracking came first to other parts of the Permian Basin before it comes to the southern Delaware Basin where LandBridge has its land. This is actually a kind of a key part of the story, because what will happen is the management team will actually look at the lessons learned from those other areas and adopt them and gain some first mover advantage in the landed area.
Yeah, maybe. I'm not sure of this. It can take some years. That is not their priority. If you look at the revenue split for LandBridge, oil and gas is just a tiny percentage. What's the percentage? Less than 20% of the revenue. Or I mean, less than 1/3. I have no clear percentage in mind, but it's very little. Very little of their revenue is coming from oil and gas, so don't expect more drilling, more oil and gas to be very beneficial to LandBridge. Most of their revenue is coming from water infrastructure. Actually, the oil and gas segment, if you look on the latest data, the revenue is declining for LandBridge. So definitely this is not their priority. Even if they improve the efficiency, productivity, I don't think it will be a major thing for the company. I mean, the management is not talking a lot about oil and gas. They just talk about water and data centers.
So that brings us really to the management team itself. And here, it's just so important. Oil and gas tends to get misses the people, but it really is a story of people. And Jason Long is the CEO of LandBridge. He is the co-CEO of WaterBridge, which we'll see in a moment is an important development. And it's a case of the right person in the right place at the right time. As he enters the picture, just as this horizontal drilling and fracking is causing this boom in Texas. Ironically, he graduated from Texas Christian University, determined to avoid the oil and gas industry entirely. And so his first job out of school was to go to Dallas and join a real estate developer. And then, unfortunately for him, his first assignment is an oil and gas developer.
Too bad.
And he ends up building a full closed-loop system for the production of oil and gas, and also the water system that ends up being sold to another company. And that kind of sets him off on his career track. And just to put it in context, right? If you're fresh out of school and your first assignment is to go out into the middle of nowhere and build an oil and gas field from scratch, and you're looking at an empty, barren piece of land, and you have to figure out how to build all of that infrastructure, it's really not easy. It requires a lot of grit, it's perseverance, a lot of determination, a lot of learning, and critically an entrepreneurial mindset. And that's really what he brings to the table and continues to deliver through his entire career, including as the CEO of LandBridge.
Yeah.
But then going back, so he starts his own company after this first assignment called Valuation Water Systems. This is around 2014. He's got a separate business on the side as well, but he's starting to get into the business of water systems for this oil and gas. And it's kind of in the name hydraulic fracking. It requires a lot of water. And at the time he's getting started, most of the water to and from the drilling pads is by truck. It's not scalable. There's just an absolute huge expansion of drilling. And he is one of the first, one of the earliest to begin putting together scalable infrastructure for those water systems in that specific location. And so he's building up pipelines as opposed to doing it by truck.
It's quite impressive, actually.
TPH Partners, we're going to see where they become important in a moment. They're an investment bank. They buy out Magic and they merge it with an existing water business, forming Penn Water Solutions, and Jason becomes the president of that company. So suddenly his business is scaling up. And with the merger of those assets, he's able to offer a one-stop shop for water management in the southern Delaware Basin at much higher volumes than you could ever achieve with trucks. By around this time, I mean, his achievements are already very impressive. Over 100 miles interconnected water pipelines, 150,000 barrels per day in terms of water production and disposal capacity. But again, he needs to scale, right? So more capital is needed to fund that expansion. And this is where 5 Point Capital Partners comes into the picture.
The money.
Business to them, and they own a company called WaterBridge, and the assets then get merged into a new company called WaterBridge And now WaterBridge becomes the larger of the infrastructure asset plays for water in the Southern Delaware Basin. He becomes the co-CEO or the co-president and chief operating officer. Again, he's the guy that knows how to build these assets from scratch, and just an excellent pick to lead the company. And so with this investment, WaterBridge is able to expand significantly. It's also able to make acquisitions, and it becomes the largest full-service water management provider in the Southern Delaware Basin, which again is the most prolific of the oil fields in the Permian.
So he wanted more capital, more money to scale the infrastructure, and now he works with 5 Point. So that's a private equity firm that will give you all the means he needs to build the right infrastructure. And spoiler alert, this is very profitable. The infrastructure now, when it comes to their geography, is great compared to what we had 10 years ago.
So just long story short, he's an entrepreneur. He's in the right place at the right time to build up significant water infrastructure assets, and then ultimately rises up to lead WaterBridge, which is the largest company in that space, in that place in the Southern Delaware Basin. On the finance side,
you start to understand why Wall Street is not interested in covering in detail the LandBridge. I mean, this is niche, in a niche market.
The second cast of characters is Stephen Jones, and he is the former CFO and former co-CEO of WaterBridge, and he's the investment banker and the deal maker in this story. He gets into investment banking very early in his career, joining Lehman Brothers energy practice in 2004. In a feat of outstanding timing, he leaves in March 2008 to become the managing director of investment banking at a company called Tudor Pickering Holt, that's TPH, which is the company that we saw on the previous page. And the time to create, this is 6 months before Lehman Brothers collapses in the most spectacular bankruptcy in American history.
Yep, fantastic timing, fantastic person at the right time, at the right moment. For these two guys, seems like they have quite a little bit of luck when it comes to timing, but still, luck is a part of life. So far, so good at the moment.
He leads TPH. He becomes involved with several companies, but one in particular called Pentex Midstream. He co-founds it. He becomes the executive vice president and the CFO of the company. They own and operate and acquire midstream infrastructure assets, and he IPOs the business for $300 million in 2014. I think barely 18 months later, he sells it to Energy Transfer Partners for $1.4 billion.
That's a 5x.
So by this point, right, he's got significant experience in leading midstream infrastructure company from initial founding, scaling the business, selling the business, and through an IPO as well. In 2016, after the acquisition, he founds another company that's focused on financing midstream infrastructure projects, and again ends up selling it for $540 million less than 2 years later. So he's got the financial chops and the deal-making chops to really be successful in this business. And he ends up connecting with WaterBridge as well via 5 Point. So he's quite established in the field. 5 Point acquires Enwater and rolls it up into WaterBridge, and he's brought in as the CFO and co-president of the company. And so together with Jason Long, they formed the leadership team for WaterBridge. That was around 2020. And by all accounts, they made an excellent team. You had, on the one hand, Stephen Jones, really on the financing side, kind of back office, deal making, M&A, really understands that side of the business. And then you have Jason Long, the operational lead, someone that knows how to build it from a barren field to constructing the infrastructure and scaling up the business in that regard. And these two together, really, they scaled WaterBridge into the dominant player in the South Delaware Basin.
Yeah.
And so with those two in place, WaterBridge really had the leadership team skilled in founding, leading, and scaling the right kind of infrastructure assets from both an operational and finance perspective. And the company was really positioned for growth. And growth is exactly what happened.
And this is quite recent. We may be in the early innings of this company in the Texas Permian Basin. TPL is an old company, right? More than 100 years old. WaterBridge, LandBridge, these are quite new businesses. Maybe we will watch this video from Steven, great video, in a couple of years, maybe in 10 years or even more, and say, oh wow, that was such the early beginning of the infrastructure play. This company has a lot of potential. This industry has a lot of potential. The Permian Basin is maybe the best basin in the US and in the world. The resources over there are great, and lands will not be out of hype. I mean, this will always be valuable. So maybe we are the first paragraphs of this big story that is water infrastructure.
So WaterBridge ends up laying the foundation for LandBridge, but they become the dominant player in their region.
By the way, when I'm saying this, WaterBridge is quite recent. Texas Pacific Land has been operating same thing, water management, since 2016. So when I say, yeah, this is the early innings, maybe I'm taking a starting point 10 years ago. So we are maybe in the first 10 years of this big development of water infrastructure and land management. By the way, the water segment of TPL, Texas Pacific Land, is growing double digits and has been growing double digits since they created this segment in 2016, growing profitably every year. That's a very good sign for LandBridge.
Little graphic on the left-hand part of this page, all of those solid blue lines, those are their pipelines. And once you have those pipelines, you don't have so many competitors left. You basically become the de facto go-to player for water solutions. And again, water is absolutely essential if you're going to be drilling oil and gas. You can't do it without. So while they build up and they scale this business, they're getting really key insights into the operational challenges that are unique in the Delaware Basin. They're building partnerships all over the place. They're constructing assets. They're acquiring assets. And they're also getting insights into the value of surface access, because WaterBridge had to acquire a lot of land in order to build their own asset base. And they recognized that managing the water is actually just one part. It's a very lucrative business, but it's one part of the overall oil and gas development process. And there's value in owning and managing the land operations. So in addition, that side of the business could unlock revenues outside of oil and gas. And so they were also potentially diversifying revenue streams. And this is actually, again, very, very similar to Texas Pacific.
Yep.
But now you get to where LandBridge becomes founded. So in 2021, Five Point carves out the land assets of WaterBridge, and they create a new company to manage those assets called LandBridge. And you can kind of think of it like this. WaterBridge retains all of the water infrastructure assets. They're the leading water management solutions company in that area. They're an operating company, so they incur all the costs and risks associated with the construction, maintenance, and operations of the infrastructure. And they operate a large piece of infrastructure with 600,000 barrels per day of water going through their system at any given time. They have permits for significant expansion, as we'll see later. And they carve out LandBridge, and LandBridge is an active land surface manager.
Yep. Basically, this is just carve out of their land management business. WaterBridge sold to the public some of the shares only for the land management part, only the most profitable part. So if you invest in LandBridge, you invest partly in WaterBridge. I mean, you have some of their infrastructure over there, and LandBridge is just the land management operation, royalty, high margin business model, recurring business model. And by investing in LandBridge, I think you invest in the best part, in the best segment of WaterBridge. So WaterBridge is doing all the cost, the big capex, the big infrastructure, and LandBridge is just getting the royalty. This is the reason why you have such amazing margins for LandBridge.
And their goal is to promote the industrial development of the surface area and the mineral assets. So they receive fees and royalty streams from WaterBridge, who's now operating on their land, as well as surface use payments and infrastructure built up by WaterBridge on that land. And they share a management team. So Jason Long and Stephen Jones are leading both. And so you've got just a very interesting play. And LandBridge at this point sounds an awful lot like Texas Pacific Land Corp. And this is where this is how LandBridge kind of comes up. It's a spin out of the land assets from WaterBridge by
Yep, exactly.
And once they get spun out, they immediately begin a series of acquisitions. So in 2021, they buy 72,000 acres. In 2022, they did another small acquisition. And then in 2023, a major piece of real estate comes up for sale, and it's right in their wheelhouse. It's right on where they operate. It's for 148,000 acres. It's a very rare asset to come up for sale. And of course, they seized the opportunity to buy this asset. This is contiguous land. It's right along the New Mexico and Texas border in the South Delaware Basin. Very, very lucrative land. And to fund that acquisition, they go public. And so they file an IPO in June of 2024. They raised $245 million, which goes towards purchasing that land, which is known as the East State Line Ranch, the Speed Ranch, and the Lea County Ranch. And these are all contiguous surface acres. As a quick side note, the IPO may have actually been underpriced. So they marketed their shares during the roadshow at $19 to $22 per share. They aimed to raise about $320 million. They ended up going public at $17 per share. Pardon me. And less than 7 months passed, and the shares have gone up over 300%. And this is for a company with fairly predictable cash flows and a lot of clarity on growth, especially in the oil and gas royalties business. These are long-established businesses. And so that does beg the question whether or not they underpriced it at the beginning, or if they left some money on the table. It's a bit of a side note, but if you happen to get in at the beginning, you've done very well in a very short span of time.
Yeah, and I will add something. In an interview from August 2024, a fund manager from Horizon Kinetics explains the reasoning, explains that there was a lack of information from Wall Street, from big funds, and they were aware of the cheapness, and this is the reason why they bought so heavily into LandBridge. They said, yeah, at $17-20 per share, you are looking at a wonderful business with wonderful margins at 12 times earnings or 12 times free cash flow. Rather cheap. In this expensive tech market, look at this. You have a beautiful business selling at a multiple of 12. So obviously it's a massive buy, easy buy. It can be called a no-brainer to some extent. So no wonder why the stock price increased since then. People start to realize that it's a great business.
And the company is able to capture royalty revenues at every single stage of oil and gas well development on their land, right? So during the permitting process, there's a procurement for regulatory permits and well site infrastructure. LandBridge collects royalties for the surface use during the infrastructure buildups, so well bores, pipelines, as well as easements necessary, so things like road access. All of these things need to be built, and the oil and gas development companies are paying for that privilege.
This is really important. This is how LandBridge is making money. At every step, they are making money. When you build the infrastructure, you pay your royalty to LandBridge. When you build some roads, factories, warehouses, you pay LandBridge. When you get some production, you pay a royalty to LandBridge. You get a royalty business with many income streams. So that is really important.
During the actual development of the well, they've got to drill the new wells. Once the drilling is completed, they've got to frack those wells in order to complete them. And LandBridge collects a fixed amount per barrel of water provided. So that's WaterBridge providing the water, and then there's a royalty that goes through to LandBridge on volume. Plus a fixed amount per barrel of produced water, which needs to be treated, because there's water going in and there's water coming out. And then once the oil and gas is flowing, they're collecting royalties again. So they're collecting royalties from the produced water, which we just saw. They're collecting oil and gas royalties, so a fixed percentage of whatever gets produced. Maybe it's based on a volume basis, I think it is. They also get revenues from selling materials, so things like sand, which need to be injected into the wells. The sand actually comes from mines on their land. And then they get also other contracted payments for other infrastructure that they use. But the long and short of it, from a LandBridge perspective, it's a very low-risk business. It's low risk, there's low expenditures, because they don't incur the risk of development, they don't incur the cost of development, they just collect the royalties. And so they get very high margin royalty streams, and very predictable ones at that. And those are distributed to shareholders via the free cash flows. And they've got four main drivers, which are worth noting. One is the surface use royalties, one is the resource sales and royalties, one is the oil and gas royalties, and then there's other commercial developments. If you were to open up LandBridge's financial statements, you'll only see the first three right now. I've added the fourth because those other commercial developments are a core part of the growth story, and revenues are going to appear in the next quarterly update in March, I believe. That should be in about a month.
Yes.
As the first fees for some other commercial developments come in. But we'll get an idea as to what the size of the business is and how it's growing. They do not have a long track record because they only have 2023 and 2024 figures out, but not even the full year for 2024. But for the surface use royalties and revenues, the royalties come in for produced water, so transport, handling operations, skim recovery, waste reclamation. They get royalties that's based on percent of the gross revenues from the use of land and or the use of the infrastructure. Those are based on volume produced. They get fees for different easements and other service-related revenues. So drilling sites, use of roads, building new roads, easements for pipelines and electric transmission. They get monthly or annual fees depending on the contract structure. But you can think of it almost like a recurring revenue structure.
Yeah, absolutely.
Very, very predictable.
Easy money.
I would assume that the renewal rates are 100% because, I mean, once it's in place, it's really irreplaceable. And this has shown very strong growth.
The switching costs when it comes to infrastructure is extremely high. So once a company starts working with their lands, it's finished. It will be recurring. You can only go up from there. It will maybe the production of barrels of water will fluctuate. If you have more drilling in the US for oil, you will have more drilling, more water barrels per day. This can be cyclical, but once you have a contract with their lands, you will work with LandBridge for years and years and years. So you definitely have a easy to forecast recurring business model.
So in 2023, they did about $26 million. In the 9 months in 2024, they were already at $40 million. The next quarter will bring that up to the full year 2024, and there's quite strong growth in this regard.
Quite strong growth, also because of the acquisition.
They also have resource sales and royalties, and so those are paid for the extraction of sand and water used in sand mining. So sand is needed for the oil and gas production. You blast the sand into the wells along with the water in order to frack the land and get the oil out. Again, it's a volume-based fixed royalty per ton, and they also get some revenues from resource sales. Again, this comes down to like materials used for the infrastructure, and those are fixed fees that are negotiated either if it's for water, it's per barrel. If it's for material, Galicia, it's per cubic yard. Again, this business is fairly stable. They did about 26 million in 2023. In the first 9 months, they did about 21.6 million. Again, once the Q4 figures come out, this business will show also some pretty decent growth.
Yeah, decent.
Regarding the oil and gas royalties, again, once the oil is being produced, they get paid for that, and they get royalty payments received on the volume being produced. And this is also based on market rates. There's some costs that come out of this, but really not much. They also get different fees based on inception or extension of different lease agreements. But this is a pretty regulated part of the business. These contracts are very regulated structures. Again, it's also based on the volume of production, so it's less sensitive to the price of oil. The price of oil may impact the volume being produced, but it's not, say, like their contracts aren't directly tied to oil prices. In this regard, growth seems to have slowed down a little bit, but again, we'll see what the figures come to be in 2020 at the end of 2024.
Yeah, the oil and gas royalties segment is not that important to LandBridge. This is not the key story here, the key revenue segment.
Main section is very, very similar to Texas Pacific Land Corp, right? So it's a traditional royalties income flow coming in from just owning land where oil and gas is being drilled. The next part, the commercial development, is where things get really interesting. Because their land is well primed for data centers. And this is in a very early phase of development. And this is a key part of the growth story. Data centers, they need a few things. Large surface area of land, they need power connections, especially or including rather off-grid power, so that they're not draining the electricity grid from homes. They need a reliable and cheap power source. They need water for cooling, and they need a fiber optic internet connection. And there is a massive number of new data centers and power plants that need to be constructed as part of this artificial intelligence rollout. And it turns out LandBridge...
Just so you know, the best state to host a data center where you have the most data centers in the US is Northern Virginia, and in second place, not far behind, you have Texas. So in the US, that's the second biggest state. when it comes to the number of data centers. So you have a lot of lands, unpopulated areas, you can make a lot of noise, you have cheap energy with cheap gas, and you have a lot of lands. This is the perfect setup for data centers. So if you think data centers will continue to grow exponentially in the US, Northern Virginia will have a lot of data centers, but Texas also. And now you have the Stargate project announced by the Trump administration, where they plan to invest dozens of new data centers. Apparently, that's the official number, but we never know. If it turns out to be true, you will see a lot more data centers, and their flagship data center is in Texas. So they plan to invest massively in Texas. Anyway, even if the infrastructure play called Stargate with Masayoshi Son and with SoftBank and Oracle Larry Ellison, even if it fails, you have a long-term growth trajectory when it comes to data center. And Texas is the second biggest state for data centers. So either way, you're fine. Either it's good or it's very good. So, that's fine. And nobody knows if the data centers in Texas will be created and developed with LandBridge. But still, this is a big picture development of this industry.
It's really optimally placed to offer a very attractive site for data center development. The fees and royalties could come from the surface access rights, the water sales needed to cool, power transmission, etc. And so just importantly, the first data center development is already underway. The first deposit of $8 million is expected in December.
Yes, they said in Q3 2024, LandBridge said that they have a, open letter of intent to have the data center. And 3 months after this, in Q4 2024, they said, yes, okay, we will have our first data center. We can confirm this. So it will take a couple of years, but it will be here. And the first one is the hardest one to get. Once the first data center is working properly, others will follow.
So it's not included in the figures we just saw in the previous slides. And there's a 2-year site selection and pre-development period that's underway already. Now, it's interesting though. So this data center build-out, it's potentially very attractive. But they have to compete for getting those data centers to their property. So we saw that there's one data center in that early phase. But again, the market for this is potentially massive, right? You have Meta spending $65 billion to build out their infrastructure. ExxonMobil implementing sort of natural gas power generation to rapidly build up power production. And there's a variety of different markets. You see that kind of picture with all the blue dots on it, where data centers are either being constructed or where they could be getting targeted. Now, interestingly, the Southern Delaware Basin is not really identified as a major emerging market. However, it does have all of the attributes that are needed, or at least LandBridge does. And that's where I think that they will actually end up attracting some development. There are some data centers already going up in the Permian Basin, so it becomes an interesting topic. And so there's some early construction already underway, and a part of these announcements has been, or a key part of attracting data centers into the Permian has been access to natural gas at relatively low cost, not being reliant on the existing electricity grids and not taking power away from people's homes, and also with access to water movement. So again, really the attributes that LandBridge brings to the table. But there's other commercial activities that are also possible, things like solar farms, wind farms, other power plants. You do cryptocurrency mining, desalination plants. Interestingly, there's been a lot of legislation.
Yeah, cryptocurrency mining, it will not be a big thing. They said that it's a quite simple project. They don't expect much growth on there. You have solar farms, wind farms, batteries. Yeah, I'm not sure of this ESG development. In the very long term, yes, but for the following 5 years, I'm not sure this will be the key growth driver for the company. Maybe I'm wrong on this, but I don't think with the current administration that you will see a lot of projects for ESG stuff, solar, wind. You need much more energy. And right now, the need for energy for AI is massive. You need maybe coal. Well, coal, it will be banned, like reduced in the US. You need nuclear energy. Yeah, that's long to create a nuclear power. And you need gas, natural gas. And that's where LandBridge will maybe make a lot of money. The cheap energy from Texas. So I don't think, these are side projects.
That seems to incentivize or give a lot of tax credits for carbon capture and storage. And so the land that LandBridge holds is also quite amenable for this. They have a lot of, their land sits on highways, so it's quite accessible. But the main commercial development focus in the years ahead is really going to be data centers. Many of the other activities are going to be linked to data centers. So things like power plant development, desalination, etc. They will build on any data centers that get developed on the land. And so that's really the history, the leadership team, and the business model. And just keeping in mind that core growth story of data centers is really going to be a key part that we'll come back to. So then diving into LandBridge's key financial metrics. Again, we're going to compare rather to Texas Pacific Land Corp because there's a lot of comparisons. There is also some challenges. So Texas Pacific has a lot of historical data. LandBridge has virtually none. We only have 2023 full year figures. But again, if you're interested, the right primer is really go to my website and see my sort of report on Texas Pacific. But the four main dimensions we looked at for Texas Pacific, and then we'll also compare for LandBridge, are royalty revenue growth, royalty yield, the coverage ratio, and the free cash flow per share. There are other financial metrics that you can apply, particularly to royalty businesses, but these are the main ones. And if these four things are showing healthy signs, and it's a resource-based royalty business, then you've got something that's quite healthy. So diving into it, the pro forma royalty revenue projections for 2024 are estimated to be 45% higher than what they were in 2023. So really quite an astounding growth rate. It really kind of speaks to the power and to the allure of the South Delaware Basin and the productivity there. If you add in the $8 million for the initial data center fee, which we saw because they've got the contract where the first payment will be made in December, that would bring your total royalty revenues up to $105 million, and that would be the 45% growth. It's 34% if you exclude the data center. If you compare that to Texas Pacific was growing about 10% year on year over the last 10 months, or last 12 months rather.
Yeah, you have for TPL you have little growth because the price of oil has gone down. So even if you do more drilling and the price of oil is going down, it will get influenced because Texas Pacific Land is much more focused on oil and gas sector, right? So you don't see a lot of growth for 2024 for TPL. And comparatively for LandBridge, they made big acquisitions, and so that adds up to the revenue. So you have the data center stuff, more acquisitions, and normal development. You have three key segments. You add them up and you have 40% growth. And by the way, for the guidance for 2025, they are expecting major growth ahead, like plus 60% growth. This is the guidance, and the growth rate for LandBridge is very promising if it turns out to be right.
Well, this is a very strong year for LandBridge as well, in excess of Texas Pacific Land, even excluding the data center developments. And it's despite the similarities in the business model, the two companies really do have different growth profiles.
Yeah, okay. And by the way, to make the acquisitions, they took on a little bit of debt for LandBridge. So the revenue is not fake, but it's boosted by the debt. Texas Pacific Land, in other words, they have a low growth, okay, but they don't have any debt. If they wanted, they could have taken a lot of debt from the bank and made huge acquisitions and increased the revenue by a lot. So don't only compare the pure numbers, look at the story behind the growth rate.
That's something to keep in mind. Regarding royalty yield, so basically just looking at free cash flow per acre, it's very high. Now keeping in mind, Texas Pacific was started as just a big land bank that was supposed to be liquidated in bankruptcy. So, not 100% of their land is as productive as LandBridge, which is extremely targeted and concentrated in the most productive areas in the South Delaware Basin. So, of course, they're going to have a very high royalty yield. Again, if you just break down, their existing M&A acquisitions, Their existing cash flows from 2023, some info from the prospectus statement from their IPO. They're doing extremely well in terms of royalty yield. I think it's yielding something like $190 per acre if you just take the 2023 revenues over the 2023 or end of 2023 surface acreage of 266,000 acres. And there's no reason why this wouldn't increase because LandBridge is still acquiring new land, and they're doing so in a way that is accretive to the free cash flows of the company. So very, very strong yield per share. The royalty coverage ratio is 1.3x. That's less than Texas Pacific, but it's still very healthy. So one of the things with Texas Pacific is that they
LandBridge has some debt. TPL doesn't have any debt.
No to minimal debt, and so their royalty coverage ratio is something like 2.5x, and that's taking basically the total royalty revenues and divided by the total liabilities, because you want to see if the liabilities are so large that it poses a threat to the company.
Basically, LandBridge has roughly $300 million in debt, and they can generate, for 2025, it will be higher than $100 million. So basically, if the growth continues, even if it's stable, in 3 years, they can pay off their debt. Debt is not an issue. But he makes the comparison, TPL never had any debt. So obviously, TPL will have a better balance sheet.
In both cases for Texas Pacific and for LandBridge, they're both in very healthy position. LandBridge is incurring some long-term debt to acquire land assets. In the 2024 figures, you've got to adjust for the IPO proceeds when you're looking at that. But they do have total liabilities. They posted at $285 million. You can adjust that downwards from the IPO. Give you about $38 million. That's still $38 million higher than what Texas Pacific has. But you end up with a very strong royalty coverage ratio. And you have a coverage ratio that's likely to improve again as maybe the pace of new land acquisition slows. Even if it doesn't, I suspect all of the acquisitions will be accretive to cash flows. So I think we'll be in good shape. But you can argue that the coverage ratio is less than Texas Pacific, but LandBridge is also much more in an earlier growth phase of its corporate life cycle. And 1.3 times is still very, very healthy.
Yeah, that's fine.
In terms of free cash flow per share, they're currently at around 70 cents cash flow per share. It more than covers their 40 cents per share dividend. And that's based on just the conservative 2023 figures and on the total share count. So Texas Pacific has grown their free cash flow per share about 12x over the last 10 years. We don't have that kind of historical record yet for LandBridge. I don't think that they'll be able to grow it at 12x over the next decade, but I would expect it to grow. And I do expect the dividends to materially increase in the years ahead. And so, at a very high level, right? So if you look at their financial metrics and you're comparing to Texas Pacific Land Corp, the company is in very solid financial condition. So this is very good from an investor standpoint because it means that the risk to your investment is low.
Yeah, basically same business model, different oil and gas versus water. More debt, more growth because of more acquisitions, and now I think in Q4 2024, I'm sure LandBridge started to pay a small dividend, a tiny dividend. To be honest, I don't really know why they are doing this. I mean, come on, use your cash to pay off your debt, or maybe take more debt to do more acquisitions. We don't really care about the dividends. There have been a lot of complaints from TPL's shareholder base. We don't want the dividends, we want the buybacks. So, but okay, now they are paying a dividend.
Got royalty revenues that have very strong growth potential. We've got a royalty yield per acre, which shows that they're managing the land very, very well. They've got a strong focus on asset productivity. Their royalty coverage is more than sufficient to cover all outstanding liabilities. So there's not really much financial risk to shareholders from the liability side of the balance sheet. And they're easily able to cover their existing dividend payout. And that's with stable, predictable cash flows. So very good news from a shareholder or investor standpoint. So they're very well managed. They're in solid financial position. The key question is, how do you value the company, and whether you can, as a shareholder, can you buy a piece of the company at an attractive price? And so with that, we're going to dive into the valuation of LandBridge. We're going to look at different growth scenarios as well. But the valuation approach is going to be very similar to the one I used to estimate the value for Texas Pacific. So again, if you look at the previous report for Texas Pacific, in it I detail out the process for the cost of equity, the weighted average cost of capital, all the assumptions that go into calculating the discount rate, other assumptions around depreciation, net working capital, et cetera.
Yeah.
And also a range of growth rate scenarios and the discounted cash flow model. Because a lot of it is similar. So things like weighted average cost of capital, we take the one from Texas Pacific and apply it to LandBridge because it's virtually an identical business in an identical area. Similar with the discount rates, similar with some of the other assumptions. We do take a little bit more, a bigger range of growth rate scenarios, but really, I'm not going to go into all the details because I've covered those ones in the previous report. So if you're interested, please just refer back to that one. So some things, however, are different from Texas Pacific in that and we need to consider those. So LandBridge, it's in an earlier phase. It's in the growth phase of its corporate life cycle. It was only started in 2021. It's a very recent IPO in mid-2024, so we have very limited historical financial statements. And they emphasize commercial developments such as data centers to take advantage of their land properties, which is different from Texas Pacific. Their land has highway frontage, internet fiber connections, access to natural gas, water, cooling, etc. So in doing the valuation, we should keep the overall process relatively simple. We'll take a similar approach used for Texas Pacific, and then ask what could be missing, since given all of these differences, and how much could that missing element actually be worth. And so to put a first conservative value on the shares, we take the pro forma 2024 EBIT, and we apply some growth scenarios for the forecast.
Yeah, now he's applying different scenarios, different growth rates to LandBridge the same way he did with the TPL. Basically, you want to be conservative when you do a DCF. You want to use a WACC, okay, growth rate, terminal growth value, and he will do a DCF based on different growth rates in the future. So you have different scenarios, and you will see he will share a table after this with or without including the data center growth.
Forecast rate from the next 10 years. And they range from low growth to some optimistic growth. The lowest being 4%, we do a 5%, the highest being 10%. And we take a base case of 7.2%. Why that 7.2%? Is the same logic that we used for the Texas Pacific. There's a way more details in that report. But just suffice to say, it's a fairly reasonable base case for Texas Pacific, which is a much more mature business, and that would reflect more of a steady state level of growth in the Permian Basin. There is some...
Yeah, I mean, this is the forecast for 10 years, right? Between 2025 and 2035. So you can't really put 30% growth. In the next year, yes, they will grow a lot. In 2026, yes, they will grow a lot. But we can't forecast that it will grow like this forever. Come on, let's be serious a little bit. For TPL, you have a reasonable growth rate, but it's not 30% per year, 40% per year, because it averages out over the years. So, okay, let's take 7% in the growth rate for the next 10 years. That's high enough. Frankly, that's high enough.
Grounds to expect that growth will in fact be higher than that, just given the different productivity attributes of the Southern Delaware Basin that LandBridge is operating in. Other key things, just really quickly, depreciation and amortization are not material. CapEx also not material.
No.
Material when doing the Texas Pacific Land Corp. I did make the adjustments for those line items in the financial model, which you can see in the report. We also apply a similar tax rate. It's pretty consistent with Texas Pacific's 5-year average, and it's also consistent with LandBridge's own tax rate.
Yeah, I mean, maybe with the new president in the US, the tax rate for all US equities, US companies will go down. So from 25%, we may go to 15%. It will be maybe a little boost to the net income, but nothing dramatic. No costs, no capex for this company.
And we also take we back into the anticipated change in net working capital over time using the Texas Pacific average. Same with the weighted average cost of capital and the different growth scenarios for the perpetual growth and the terminal value part of the model. So taking into that conservative approach, you get average.
Wait, I take a WACC of 80%. Okay, perpetual growth of
So taking into that conservative approach, you get to triangulate in on what would be a conservative or a base case for what the value would be. We just kind of look at that base scenario of 7.2%. We take a perpetual growth rate in the 3 to 3.5% range, and that kind of gives us that conservative value. based on similar set of assumptions that we use for Texas Pacific. It does leave some questions unanswered, such as what if the forecast period growth is too modest in our assumptions, and what about data centers? Texas Pacific does not focus at all on data centers. So we're taking this as a first step, and then we'll come back.
I mean, yeah, TPL for the moment is not really focusing on data centers, but maybe in the future they will. If you look at the earnings calls, yeah, there is a mention of AI and data centers for Texas Pacific Land. That's in the project. It's just that the way they have some lands, it's more difficult to have data centers for TPL. You have a little bit of land over here, and then over there, and then over here is like a big checkerboard of lands. For LandBridge, it's contiguous land. You have a big chunk of land, so it's easier. You have more space in the same area. But yeah, that's in the process also for TPL. Maybe TPL will do small bolt-on acquisitions of small parts of lands to welcome these data centers. This is not out of the equation at all.
We'll try to add things back in, or it's something that investors can ask themselves. So if LandBridge was a mature company similar to Texas Pacific, taking all of those conservative estimates as before, we would estimate that it's probably worth about $43 to $50 a share, or $53 per share. But that's really just taking the oil and gas royalties business, the usual water business. It doesn't take into account any of the extra commercial developments like the data centers.
Okay, two things. First, now the stock, as I'm recording this, is around $60 per share, 65. So we are not far from the current stock price. If you think these are your assumptions without the data center story, just for the water and oil and gas, maybe the fair price for the business is, $50? Okay, so maybe the stock is 20% overvalued. Okay, fair enough. The fund that backed and is backing LandBridge, called Horizon Kinetics, estimated that this business, just for the water infrastructure, without the data centers, this business, LandBridge, can grow easily 15% per year for the next 5 years. The earnings can grow 15% per year. So maybe in this table that's a bit conservative. They said 15-20% without the growth in data centers. If you add the growth in revenue coming from data centers, it will grow by more than this. So this is a table being really conservative without any growth coming from the data centers. So if this is your very conservative assumption, then the stock is a little bit overvalued. Now the stock price is $60 compared to a fair price of $50, being conservative.
So at today's price of around $62 per share, or the range of 60 to 65, it would seem overvalued. So if you were just taking the model that you use for Texas Pacific and you apply it to LandBridge, you might say, it's overvalued, it's really not worth it. But it just doesn't take into consideration the potential for higher growth in the short term, and there really are reasons why you would consider higher growth as a potential thing. One more point before I just jump to the next page. If you were to take LandBridge's most recent prospectus, the S1 when they went public, and you compared it to the most recent 10K annual report from Texas Pacific, LandBridge mentions data centers 38 times. Mm-hmm. Texas Pacific doesn't mention it at all. So this is really a different and a critical piece of the growth story for LandBridge that is not in the Texas Pacific horizon at all.
Oh, I see what he means. Officially in the annual report, the impact of data centers will be much more massive for LandBridge. So now we are being conservative without taking into account the data center story, the data center growth prospect. But this is a major part of the story. Maybe this is what he's saying in terms of revenue growth in the future. But yeah, just to confirm, in the latest earnings calls, TPL's management is talking about data centers. Well, first, the guidance. They guided for 60% growth for LandBridge for 2025.
So very conservative. We're starting at this $43 to $53 range, and then we're asking, okay, what else could be there? Because it's a new company. It's in an earlier growth phase. It's got a very strong focus on extremely productive land assets. So when it does buy land, it's buying land that it's at the highest end of productivity in the most productive field in the United States. The executive team at LandBridge has an entrepreneur mindset. I think this is actually a really critical piece of the story that gets overlooked. You've got Jason Long, who's in there. He's grown the business basically from scratch. And he's the kind of person with a very strong track record of growing businesses and on delivering on growth targets. WaterBridge, the sister company, has approved permits already in place to expand the size of their water production business by 50%. If they were to actually develop that, that would directly translate into royalties for LandBridge, and that's a very strong signal of potential growth. 50% is nothing to be shy about. There's also, from a political standpoint, President Trump has just been reelected in late 2024, and by every indication, he intends to give a very strong mandate to boost domestic oil production. And if domestic oil production in the United States is going up, the first focus is going to go straight to the most productive oil field. That's in the southern Delaware Basin, and that's where LandBridge's land surface area is.
Yeah, that's a small part of revenue.
Very positive in the short-term boost for the royalty streams. And then finally, that data center construction, potentially a huge growth driver. If they can attract developers, this could be a really big piece of their business over the long run. They've already got a proof of concept underway with that joint venture with 5 Point, and it's already in the early site selection phase. And the revenues are going to come into LandBridge, the first payment in December of 2024. And I would just mention something else about data centers. The first one is always the hardest to build, right? So when you have an empty plot of land and you're building a data center, you've got to build all the roads, the power connections, the water pipelines, all of this stuff. Once you have that in place, a lot of the infrastructure that needs to go in if you have a second data center being built is basically bolt on to the first stuff. So it's the most expensive and the most risky to build the first one. Once that proof of concept is in place, the other ones could come a lot quicker. And so, again, you've got a land that is very well placed to be attractive for data centers. It's got power connections, it's got water for cooling, it's got fiber optic, it's right on the highways, it's got a land owner that is very amenable and wants to develop it commercially. It's got access to cheap natural gas to power those data centers. And they're building the first one. And again, I think if they get the proof of concept, if that first one really goes well, I think you can look forward to a lot more data centers coming in. That would be a significant new revenue stream for LandBridge, and one that would be super stable, super predictable, extremely long-term recurring revenue source. It would essentially flow straight through to shareholders in terms of cash. So.
Yeah, I think it was the management or some research that said that every data center would bring an annual recurring revenue stream of $30 million. And LandBridge has the space for the moment to welcome 6 sites of data centers. So that's $180 million of potential revenue, recurring, high margin streams that can come and go directly to the bottom line.
If you were to have 2025 and 2026 be similar to 2024 in terms of growth, especially for their earnings.
So 40% growth.
Constant. The picture you see begins to shift significantly with regards to LandBridge's value. So we saw in the previous scenario with the kind of base case modest growth about $43 to $53 per share. If 2024 repeats itself in terms of growth rates in 2025. So all you do is change 1 year of growth rates, and then you hold everything else constant and returns back to your base case of 7.2%. Your value instantly goes to about $50 to $61 a share. If it goes for 2 years, you're looking at $58 to $70 a share. And so you could make an argument that today's share price is essentially factoring in about 18 months of current growth rates to continue for the next 18 months. But as we've seen before, there's actually reason to believe this could well continue beyond 18 months. And if so, it could be something that's extremely attractive for shareholders and something really to consider. So,
imagine you bought the stock at $20 per share. You would be very comfortable sitting on this amount of profits. Yeah, basically, if you add up if you think the growth will continue, well, this is expected for 2025. There is a guidance that is through the roof, amazing. If you think the growth will continue in 2026 and then will stabilize, will slow down a little bit, then the stock is fairly valued, a little bit cheap. And if for some reason the revenue growth is not 7% for future years, but it's 10%, 15%, for some reason you have a lot of data center build-outs, the stock is very undervalued. But that's a very bullish scenario. I mean, this is the perfect golden scenario. But yeah, just so you know, if you take the most conservative scenario without any data centers, the stock is maybe overvalued by 20%. And if you are more reasonable, what is likely going to happen, you may say the stock is fairly valued or rather cheap.
Trying to summarize it, LandBridge is an extremely solid business, right? It's a very high quality management team. It's got an exciting growth story. It's different from Texas Pacific Land Corp with that growth. The business model, very attractive land assets. They're highly predictable, long-term, low-risk, recurring royalty streams and profits. The land assets are in a highly conducive space for data centers and other commercial developments. There is, at the moment, a massive expansion in artificial intelligence infrastructure being built out, and LandBridge has the assets to capitalize. The land is along the highway, it's got fiber optic connections, access to low-cost power, cooling, water for cooling, etc. Critically, the leadership team has got a track record of delivering. Very experienced leadership team, outstanding record of building and scaling businesses, particularly in this kind of infrastructure assets kind of business, and a great track record of returning value to shareholders. This is an extremely positive thing. As an investor, it's the kind of leadership team you would want to bet on. The growth story, again, this is where it really kind of differentiates itself from Texas Pacific. The core business has got significant growth potential through M&A or organic development. So WaterBridge has that expansion, permitted expansion for 50%.
Yeah, that can be big.
In its capacity. You've got data centers. That's a rapidly growing market. LandBridge is ideally placed to capture that. And the first data center is already in development. That's a very promising thing, a very promising sign for potential investors. The first payment was received in December 2024. And so nothing from that data center development story has shown up in any of the financial statements so far. And as a result, if you have sort of an automated model or an automated valuation model just based on pre-existing financial statements, you're going to miss it entirely. And so if you believe that the growth potential is there and that management can deliver on that growth, then I think LandBridge becomes a very compelling investment opportunity. The company's in very strong financial condition. It's got strong financial and operating performance. This really mitigates the downside risk for investors. If you think of that extremely conservative valuation, I think at the low end was $43 per share.
Yeah.
It's going to be trading about $60 per share, or $60 to $65 per share. So you can think of that 43 almost as a lower bound. So you do have some downside risk, but it's not that significant when you consider the possibility for the upside on the growth assumptions. So again, like under those very modest growth assumptions, $43 to $53 a share. If those current growth rates persist, even just for 2 years, $70 a share is not out of line for what we're looking at. And at the time of writing, it's trading roughly $60 to $65 per share. So that implies about 18 months of these similar growth rates that are currently expected by the market. If you believe that those current growth rates can continue beyond 18 months, then the shares are actually quite undervalued. And you can see just the trend. Like I didn't run 10 other scenarios, but like if those growth rates were to continue just for say 3 or 4 years, but there's some significant upside potential. Likewise, that data center construction boom could be a lot larger than people think, and I think that's also something that's really worth considering. And so with that, that's really the story of LandBridge, it's one of the most interesting new companies in the Permian Basin. Royalties-based business, a bit unusual in terms of business model because it's not an operating business, they just sort of collect royalty streams, but it's got a very attractive growth story. That growth story is not seen in the current financial statements because those financial statements are so limited in terms of it goes back 1 year. And the first payment for data centers is only being received in December. So it hasn't even shown up. It'll show up in the next quarterly report. So really something to consider. And just, again, if you buy into the growth story, these shares could be very attractively undervalued. And even if the really optimistic growth scenario doesn't materialize, the company is pretty fairly valued at this place. So definitely something to consider. And so a big thank you to everyone who's listening to this report. The slides will go up on my website. They should be accessible shortly. It might just take
Okay.
But a big thank you for all of listening. If you want more of my content or if you're interested, please subscribe to the McNamara Brief. This is the first one that I've done.
Okay, please subscribe to Steven, that's some great work. Congrats. And yeah, I tend to agree. If you cross-read what Horizon Kinetics has to say about the business, they think that the growth will continue, and they think that the big energy needs for AI, for tech, is undertoned right now. Horizon Kinetics, the big shareholders from TPL, Texas Pacific Land, they think that the need for energy is much more massive than we anticipate. So the build-out infrastructure, this stuff will grow much more than we think. And if they are right, you will see much more revenue for LandBridge. So if Horizon Kinetics are right, LandBridge is extremely cheap. And even if it's not extremely cheap, it's rather cheap, it's still a wonderful investment with a lot of margins, some great management teams focused on water development, experts in their niche. They have some good lands in a good geography, and they seem to know really well what they are doing. They don't have any competition. I mean, this is land management, so you can't really compete on land. You have the lands and nobody can steal your lands. And the runway for land management is huge. We've seen this with Texas Pacific Land. The runway is decades and decades and decades, if not centuries. So I think this is a very compelling investment opportunity. I think it can double. Maybe I will be completely wrong on this one, but yeah, I mean, this is a 5 or 6% of my portfolio. If the stock drops for some reason, some AI scary movement, some recession or somewhat, I think I will buy more, a lot more of LandBridge. But for the moment, I'm fine. This is 5 or 6% of my portfolio. And yeah, looking forward to reading their results. They have their quarterly report soon. And I'm really interested in learning more about this growth story for the coming years. Thank you for watching. I wish you a nice rest of your day. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.